Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. Today is Wednesday, January 10th. This is host Richard Benuli. Today we have Dr. Marc Faber and Ira Harris. Dr. Faber is the editor and publisher of the Gloom, Boom, and Doom report, website gloomboomdoom.com, which highlights unusual investment opportunities. It's a great publication. I'm actually a subscriber and learn immensely from the insights of Dr. Faber. He's also the author of several books and well known for his contrarian investment approach. Ira is a hedge fund manager, global trader in foreign currencies, bonds, and commodities, equities for over 40 years. He has served as CME director from 1997 to 2003 and also a stint most recently. Welcome, gentlemen.
Well, thank you very much for having us.
Yes, thank you. Thank you.
Yes, thank you, Dr. Faber, for coming back on the program show and your time on this discussion. Wondering if we could begin, Dr. Faber, with your global macro thoughts on the economy and the financial markets in general.
Well, I looked recently at some statistics about tourism expenditures in Hong Kong and in Thailand, and they have recovered, of course, from the lows in March 2020, but they're still way below the peak in 2018, 2019. And even during Christmas, domestic consumption in Hong Kong wasn't very strong, partly because there are lots of Hong Kong people that will leave Hong Kong over long holidays or long weekends and go to China, whereas the traffic from China hasn't picked up dramatically yet. Although I have to say, I was recently at the Grand Hyatt Hotel in Hong Kong in early December, and it's interesting, I mean, from a perspective of global trends, whereas 25 years ago, when I went to the Grand Hyatt, 80% of the tourists were foreigners from Southeast Asia, Europe, and the US. Now 80% are from China. I mean, the club room upstairs, which is very nicely decorated by some French decorator, is wonderful, but it's full of Chinese because Hong Kong is becoming less international and more a Chinese city within a huge empire and within the so-called GBA, the Greater Bay Area, which includes essentially the territory, the southern territory of Hong Kong around Guangdong province. And Hong Kong will be an important center within this Greater Bay Area. And the Greater Bay Area is growing rapidly and has about 80 million people. So the character of the city is changing, and what has happened is that the sentiment about China and Hong Kong has been extremely negative. So you can now find in Hong Kong property stocks that are selling at 70–80% discounts to asset values. Now, I do not debate the fact that property prices can continue to go down somewhat in Hong Kong. But if you buy a quality asset at an 80% discount to the asset value, you're buying it at a relatively low price amidst very negative sentiment. Whereas, say, in the US, you could buy the Magnificent Seven at high prices amidst extremely optimistic sentiment.
Interesting. And do you think that there could be any issue with like the forbidding of investments by, say, the Western world investors say in the US, into Chinese equities in that regard?
This could be the case. And I'd just like to point out that the sanctioned stocks, the US State Department is actually a very good stock picker, because each time they sanction a Chinese company, the stock outperforms the market. So say two stocks that did well over the last 12 months are China Mobile and CNOOC. So I wouldn't worry too much about it. And number two, I think personally, if Americans, the State Department, that is not exactly the most enlightened State Department, although Mr. Blinken, I have to concede, is a very hardworking man. That I give him credit for. I'm not so sure about his policies, but he's hardworking, at least, contrary to other people in the US Biden administration. But the money nowadays that flows into Hong Kong and into Asia in general is actually accumulated wealth of Asians. This is a big difference, that whereas in the past the money flows were strong out of British institutions, American institutions into Hong Kong, China, nowadays there's a lot of Asian money, and the money accumulation in Asia has been gigantic. Just in the last, say, 10 years, the wealth created in India has been incredible compared to, say, Britain, that previously was controlling the Indian subcontinent as a colony of Britain. So it's a new world, it's a different world, and there are tremendous tensions in terms of trade and geopolitical tensions and so forth and so on. We don't know what the outcome will be. I have a little bit a negative view that the outcome will not be very favorable in the immediate future. But long term, I think Asia can stand on its own feet, because it's a region with more than half the global population. And we have all the technologies, we have all the resources we need, and so forth and so on. So I'm sort of cautiously optimistic. In the meantime, there are, as I explained, many stocks that are very inexpensive.
Those are good points. Yeah, very interesting. And your thoughts, Ira, on the global macro and financial markets?
We returned, and I went and listened, Dr. Faber, we did two podcasts last year, but the one we did in January of 2023, because for everybody who says, well, nobody got this right. Yeah, I think in our podcast, we were both not as optimistic on the US, although we certainly understood the amount of liquidity that was coming in. We talked about it. But I think, we covered the bond markets very well, all the debt markets. And I will tell, in case you forget, you were very bullish on Brazil and Argentina, which were both absolutely right. And Richard, that you and I went on that, because when we were on with somebody else, I won't, who was bearish, Brazil because of Lula. I think a lot of Wall Street people fail to understand Lula, and Lula has actually been pretty good for Brazilian equities. If you go back to his first run, he was good at attracting capital, and Brazil has done very well at attracting capital. Brazil and Mexico probably have the highest real yields on overnight money of anybody that there is, and it's paid off. We were both very bullish Japan. And as we sit here today, Japan is making 34-year highs in the Nikkei. Well, off of especially last night's low wage, wages were not. So that's where we were last year. And I think, I still, we talked about Asian banks, and I think Asian banks are still good, especially I'm still very bullish on Mitsubishi and Mitsubishi Tokyo. But we had also talked a lot last year about UBS. UBS has been, because of UBS's huge footprint in Asian wealth management. I mean, all the mistakes that have been made in Western banking, and there's been plenty, but UBS pivoted, especially once Axel Weber got onto the executive board. I think they've made some very, very good changes, and they got away from the horrendous Goldman Sachs model of just being a hedge fund. And they've done, and the stock and Credit Suisse was an unforeseen bonus, but we'll see where that goes. But I think Asia is a very, very good story. There's plenty of capital, there's plenty of innovation, and there's plenty of high quality domestic investment going on there, especially on, as they reshore out of China. So that pits us to where we are today. So when we left off, I think, when was that last podcast? Maybe in, I forgot when it was, Richard. It was maybe in the summer. I don't know. But things are really getting to me, very, very interesting. And still, we talked a lot about debt last year, and now we've reached some of those levels that really scared us. And the U.S., for all the uncertainty, as you point out, that exists in the world, and whatever movement, the dollar is not acting in its typical safe haven status. The dollar is not. It's not doing it. So for people who are going running, I say be careful, because the U.S. deficit situation, to me, is probably of paramount importance as we go into 2024. So I don't know if we're going to talk about that, but that's where I would leave off.
What are your thoughts, Dr. Faber, on the U.S. debt situation? Is China not buying U.S. debt anymore? Are other BRICS countries also not buying? Is the only option for the Fed to monetize the debt?
Well, in my view, there are two developments that are very important. The freezing of assets and the threat of expropriating assets of Russians also in Europe. This threat exists. And also the Gaza war. I mean, I do not wish to discuss who is wrong and who is right and so forth, and the historical background that led to the war. But the third world, the BRICS and related countries, which is 88% of the global population, they see the duplicity of the US in this game, and they perceive the US as not being particularly friendly towards anyone except their allies. And so countries like Brazil and Indonesia and Bangladesh and Pakistan and India and China, these are all countries with, in some cases, over 1 billion people, and in some cases 200 million people or more than 200 million people. This Gaza thing, problem is actually uniting the BRICS countries sort of against the Western alliance, because the other world, in other words, the South, as they call it sometimes, or the emerging world, they think that the Western world is not doing sufficient to stop the slaughter of civilians in Gaza, in the Gaza Strip. And that leads to even Indians and Chinese talking to each other and being on friendly terms. There will never be a political unity between India and China, but they've kind of become closer as a result of these steps undertaken by the US government. And the measures that the US has taken to freeze assets, including of a very poor country like Afghanistan, where people are actually starving, is a disgrace. And so more and more countries, and we see it in the gold purchases, actually, I'm sort of surprised that the gold price is not higher, given that central banks around the world are rather buying gold and keeping reserves in US dollars. And what Ira said, I fully agree. In my view, the dollar peaked out in October 2022. There were two headlines. One was, I think, in Forbes, and the other one in one Business Week's Bloomberg, the unstoppable dollar and so forth. So this was the peak of the dollar. And since then it's weakened and then rallied again and then weakened again. And now the question is, will the dollar rally in a final move upwards or trend downwards? My view is that the dollar is actually very vulnerable, but other people disagree. And I wouldn't bet my farm on the dollar weakening. But I think the trend will be down over time, over the next 10 years. And I think that the debt situation in the US is hopeless. What hopeless means is the deficits will stay high and, in my view, expand, because the deficits are already very high. At the time, the Treasury Secretary has the audacity to write an article in the Wall Street Journal telling the world that the US economy is all great. When the Census Bureau publishes statistics that show that household income in real terms is down over the last 2 years. And the secretary goes and says that people now have more money than in 2019 and 2021. The Wall Street Journal fact checks everything except what the government is saying. That they let it go, pass. That is the media nowadays. They are a broadcaster of governments, nothing else.
Yeah, that's an interesting point. And your thoughts, Ira, on that?
Well, on that point, I agree totally. And it was interesting, and I've talked to some other people, because, yes, they're just all that journalists do today they just want access to the powers, whether that power is defined as being a billionaire or somebody in government who they need. You watch the way they handle those press conferences with Jerome Powell. Believe me, they should give them all a Larry King Award for asking the softball questions. Nobody goes and discusses. And it's just pathetic, because it doesn't, I absorb a lot of news, and the better the journalism, the easier my job is. But I spend so much time digging through what they don't cover. So when Dr. Faber talks about that, it's 100% right. And now I tried to defend Yellen at the last podcast, and Dr. Faber let me have it right here between the eyes. And I have to say, 100% right. And I said, she's a terrible politician. She is a terrible politician because she's so uncomfortable doing it, but everything she says, and right now, what she did on December 12th and 13th, right when the last Fed meeting was going on, she was very vocal out there talking about inflation being beaten. In fact, I had that conversation on the Tuesday one when she did the interview, I believe, on CNBC, and I wondered whether she was still Fed chair or not, the way she was speaking. And then, of course, you have Brainerd. So the White House comes and they do this, and they're in a bad situation, because when rates went to 5%, well, 4.999 on the 10-year, right, back in October, they got very nervous. And she made a gigantic mistake and front-loaded all that debt. They cut the amount of coupon debt that they were going to issue and did much more in T-bills, right? Terrible.
Yes.
So now they're paying more money in the hope they really have to hope that the world's going into an absolute slowdown. Otherwise, they've placed themselves in a terrible situation. So now they're trying to force, and this is where the politics of the Fed, and whoever says that the Fed's not political has no, they need to go read Alan Meltzer, The History of the Federal Reserve. There's plenty. Well, we'll go back in the 40s. We can go back in the 20s. When they were trying to aid and abet Britain, when Britain wanted to go back on the gold standard and everything that was being done there. So the Fed is notoriously political, and we don't even have to remember when Lyndon Johnson was physically attacking McChesney Martin and had him up against a wall. And of course, we know how Nixon and company beat up Arthur Burns. So the Fed is notorious. Well, we have 4, 5 appointees of the Biden administration, which, by the way, are all at the behest of Yellen and Brainerd, who are labor economists. And Powell has done everything he could, in my estimation, to create, because Powell is a consensus person. So he wants no dissenting votes at the meetings. I don't believe that can go on for much longer, because you're going into an election, and it all depends on what you look at. But there's a lot of labor economists who tend to be far more dovish on interest rates because, like Ford, they view the employment situation as job one. And believe me, from a moral perspective, I absolutely agree. From a monetary perspective, and I'm a sound money person. I don't want just like I criticized Powell back during COVID, all of a sudden he became the minister of social justice as he proclaimed that anybody who lost their job, the Fed would not move until anybody who had lost their job due to these policies put in during COVID had their job back. Well, we know how well that worked out. So I don't want, Adam Smith was a great moral philosopher. People forget that. He was a moral philosopher first, and I think an economist second, but he melded the two pretty well together. I don't want a moral philosopher. I want somebody who understands sound money, but I think that's going to be lost as we go forward. But they're in a situation where they're going to have to find a way to get the overnight interest rate and short-term interest rates down. So they're going to have to steepen the curve. We're still inverted by on the 210 I'm looking at by about we're still a negative 35, 34. They're going to have to flip that because they're going to have to push overnight rates down to ease the burden on both the Treasury and the Federal Reserve, and especially on the Treasury. I mean, we already know, we talked about this last year, that the interest on the U.S. debt at this point is greater than the defense budget. This is a very political, difficult situation. And this is going to play out, and how it'll go, we shall see. But this is a very difficult situation. And I think the first key will be when you start to get open dissent at the Fed, because it will come not from the hard money people, hard money. What a misphrase that is. What it used to be Waller and, of course, Michelle Bowman. She's already this week moving her stance. So there's a lot going on. And I turn to Dr. Faber because this has certainly, over his lifespan, been his strength. So we can discuss this more and more.
Yeah, Dr. Faber, your thoughts on how the trends in currencies, interest rates, and inflation could play out between Europe, Japan, China, and the U.S., given these geopolitical and central bank issues we've been discussing?
Well, the honest answer is I don't know. But it seems to me that one development is clear. The Fed and the Treasury in the US and the government is one and the same. And two, the US has basically now 3 options left. They could increase taxation massively and reduce the deficit. That they will not do, because increased taxation usually falls on the lower middle class and the middle class. And these are the people that are not doing well economically. Just consider the affordability to buy a house. It's now at 16%. This is the lowest in the history of the United States, because property prices, housing prices are sky high, whereas wages haven't gone up at the same rate. So a young person coming out of university or having finished his apprentice and is starting a business or starting to work, he cannot afford a decent place in the center of a city in the US. He has to move far away. The same in Europe, by the way, I have to admit that. But it's a tragedy that the affordability has been diminished this much by central banks' policies. That has to be stressed. Number two, in absence of increasing taxation dramatically, which would produce most likely a recession, they can default. But the default of the US government on its debt would be extremely painful, because the bulk of US debt is actually held by insurance companies and pension funds and so forth. And if the US government defaults, then the states will also default. And you have a huge mess. The third, that's the easiest option. That is the least obvious to ordinary people. But of course, it benefits the rich. And that is printing money. And that's why I think it's inevitable that the US sooner or later embarks. And when they started with QE1 in December 2008, it was announced, I think it started in January 2009. I said, this is not QE1, this is QE infinity. Because once you embark on money printing, there's no way out. There is a way, but it's rehabilitation, and it takes a long time, and it is very painful, certainly initially. So my view is that the governments, given the high level of debts, and as Ira just pointed out, the interest payments on the government debt, they reached or are at $1 trillion a year. Most countries in the world don't have budgets of $1 trillion a year. And then you talk about the unfunded liabilities of the government, social securities, and then I think they will print money, and I think they will cut rates. But the big question, and I was wondering what Ira thinks about this, given that the 10 years Treasury is now, say, around plus minus 4%, if you cut the Fed fund rate, will the 10 years Treasury rally or go down? My view would be, as a Treasury buyer, I would love to see short-term interest rates going up much more, to say 7-8%, because that would kill the economy and be bullish for bonds. But to cut interest rates here, given the excess liquidity we have, and we can say there's plenty of liquidity, otherwise stocks wouldn't have gone up so much in November, December. And even speculative stocks have gone up. And if there was tight liquidity, Bitcoins wouldn't have doubled in price, and the gold price wouldn't have gone up, and so forth and so on. And the credit spread would be wide and not tight as they are now. So if you cut interest rates too soon, within 6 or 9 months, you will have a reacceleration of inflation. And I can tell you, there's a lot of companies, particularly in the service sector, that are just waiting to increase prices.
Yeah, interesting. Your thoughts, Ira, on that question from Dr.
Well, I think that even if they cut rates, I think the 10-year is going higher. It'll go down first as everybody gets a little excited, but then they're going to show their hand. And I mean, again, Dr. Faber, we've had this discussion twice last year. Who would be extending duration at this time? There's too much uncertainty for me to extend duration. I can get 5.4 on a 6-month T-bill now. What do I want to extend my duration into this mess? Because as you say, if I knew that they were going to raise taxes, which of course they won't do, it's an election year, which weighs heavily on this. Yellen and Brainerd was out yesterday in a Bloomberg interview, and the way that they want to push inflation down is still going after corporations, because she was talking about that there's a need that inflation is a little stickier than usual because corporations are still not rolling back the price rises, right? So yes, they're still going down that road, and that is poignantly going after Powell. Now, Powell was really interesting, and we can go back there at his December 13th press conference, because I listened to these press conferences, each and every one of them. And this one, and I also trade during them just to see what's going on, but in this one, Powell never tried to back off from the dovish rhetoric that he used. Never. And if you look at an S&P chart, you look at a gold chart, you look at a dollar chart, there was never any correction while he talked. It was all so dovish. Never tried to respond to it. And then, of course, 3 or 4 days later, the dwarfs, or the regional Fed presidents, as I call them, they are dwarfs. They're dwarfs, and they're giants in their self-importance, but they're dwarfs because they don't really even matter, because the Fed could go change the interest on excess reserves with just a vote of the governors. They don't need the Fed. That's in the Federal Reserve bylaws. So they're dwarfs. They talk a lot, and they talk with and they never get challenged by the media because, again, the media, it's one more soft story. Let me do an interview with you. Every time the FT interviews Mary Daly, it saves me having to buy any more toilet paper because that's worthless. But they all want access to that. And so we're going to be into this game. But you saw it yesterday again with Brainerd. Brainerd they're trying to push the Fed because they need lower interest rates. This is a real problem for the Treasury and therefore the Fed about the financing of the deficit, and the fact that Yellen went so far in issuing T-bills because they didn't want any more pressure. They were really afraid of the quote unquote bond vigilantes late into the year. And when you saw the 10-year start to approach 5%, and as it approached 5%, what did mortgage rates do? They went over 8%. And that scared them. And then all of a sudden, they're all talking about the housing. Well, there's a housing shortage. So that's under the guise that they'll continue to try to push interest rates down. But to answer, that's a long answer to Dr. Faber's question. I see, I think the 10-year, unless something catastrophic happens, I think the 10-year at 4% is, I would probably say, fully valued. Unless, now, if there was really a Volcker here and the Fed was going to stand in the middle of election, but of course they won't. This is the politics of the country are so divisive. So for them to start raising rates like a Volcker, even though Volcker didn't raise rates in the 80 election, and he would admit it was probably one of the mistakes because he backed off, but that's just not going to happen. So where do we go? I don't know, but I think the 10-year, I would not be buying anything more than a 2-year because I don't want the capital risk, because there's just too many unknowns here. And again, depending upon who wins this election. And Congress is no great shakes either, by the way, as we see, right? They just came out with their new budgetary agreement, and it had 16 billion in cuts. And what were the cuts? 6 billion was from unspent COVID money, and 10 billion was from the IRS, which they couldn't. Remember, they were going to hire 87,000 new IRS people. You couldn't find 8,700 to hire. I don't know what they're thinking about. So they didn't spend that. So yes, they're so frugal, these people. And Dr. Faber and I have discussed, and I loved him for it, on the defense budget, because he's this anti-defense budgeting, not anti-defense, but anti-defense budgeting, because it's miserable. And that paves the way, that opens the gates of hell for so many other budget malfeasance. But we had that discussion, so we don't need to go there. But to me, if we talk about the 10-year at 4%, there's no attraction for me there. I can park myself in T-bills, have no capital risk, and earn more. So I'm not looking for a lot coming out of there.
Yes, I agree. I mean, given the potential re-acceleration of inflation in future, I think at 4%, the 10 years note is not particularly attractive.
Yeah, I heartily agree with you. It's just
but
not
equally, I'm from Switzerland. The 10 years is at around 1% or less. So it's not very attractive either.
Well, I'm glad you brought that up. I think yesterday was about, where was it? I have some numbers on Switzerland, 87, and it was all the way down to 55 not long ago, 55 basis points on the 10-year. But I have a question I wanted to ask you, because I saw for the second year in a row, the S&B is going to post a loss this year of 3.5 billion Swiss francs. Now, I follow the reserves of the Swiss National Bank, because the Swiss National Bank, to me, if I was in graduate school today, that would be my dissertation on what they've been able to pull off here with the greatest bit of alchemy in the world, because they took Swiss francs, they printed Swiss francs, they sold them to a market ready to take them, and then invested in foreign equities and bonds. And so, yes, 2022, I know they lost a lot of money, as they should have, but how did they lose money in 2023? The S&B is showing a loss from the last I saw, so there will be no money coming back to the cantons. But this should be very disturbing for Swiss citizens.
Yes, maybe it should be, but it isn't at the present time. But it may become a problem in future. But this is true. The Swiss National Bank has become something like a gigantic hedge fund.
Yeah.
But in defense of that, some countries, they have large sovereign funds. We in Switzerland, don't have a large sovereign fund. Our pension fund system is relatively well financed, because like my Social Security, now I get it. I'm a pensioner. But I had to pay all my life into a fund, so I get the benefits at the present time. The problem is that we have a lack of young people that pay into the system, and because of modern medicine and because of social thinking, they keep elderly people alive forever. The life expectancy in Switzerland is significantly higher than in America. So we also have problems, but I'd say we have less problems, although I personally think it's a disgrace that Switzerland has moved so much to the left, and that Switzerland, there are a large number of people who want to become a member of the EU, and worst of all of NATO, that is in my view a criminal organization, nothing else. So I'm in the committee of the initiative to launch a referendum about Switzerland, the neutrality being anchored in stronger words within the constitution. But we have difficulties in collecting signatures.
Yeah, but I'm surprised because they've done a great job. Look at what they did to try to keep the Swiss after they let the peg go in January of 2015. They've done the best job because they at least bought assets more than just bonds. So when you saw that they were the third largest holder of Apple stock, they did a very good job. And meanwhile, they've rolled it back because at one time they had going into 2022, I think they were at 930 billion in foreign assets, and they're now taking it down to 650 billion. So they've been busy shrinking their balance sheet, which is why, to me, the Swiss franc has really held up so dramatically well. You had Euro Swiss make lows at 92 levels, and the Swiss yen was made all-time highs throughout this as they were going that route. So look at the world allowed them to get away with what they did, and they did it very well. And by buying global equities, and now they're systematically shrinking that portfolio. But I'm surprised they haven't bought more gold, because I know there was a big issue in Switzerland when the S&P sold off some of that gold, and it was a good time to. They haven't done that yet. But I love talking Switzerland because they are such an interesting place to watch. They're a mosquito in the global world, as its size. But we know that mosquitoes can do a lot of interesting things, and the S&P is quite dynamic in that regard. Richard, whatever else we're going to do. I just wanted to raise one point, though, that I forgot, going back to Dr. Faber, when he talked about the global South and how they're disillusioned with the United States. But the United States also has the ability. Look at what happened when Nippon Steel said that they were going to buy U.S. steel, right? And now all of a sudden, Japan is, if they're not a tier one ally, and the United States asks a lot of them, especially in the Asian world, and they immediately go to CFIUS to block it under a strategic rationale. So even if I'm a U.S. ally, I have to question. And that, of course, raises that issue when Macron went to meet with Xi. When was that? Back in April or May of last year? And he made that comment, we will not be a vassal of the United States. He didn't say the United States, but we knew what, and that Europe needs to set its own foreign policy. So even for U.S. allies, they have to be careful. And Macron cannot claim to be misquoted because there was embedded. He did that interview on the flight back from Beijing to Paris with Politico. And when Politico published the interview, at the bottom, they made a statement going that Politico violated its own program because they allowed the Élysée Palace to edit the interview and to see it before it got printed. And they wrote a paragraph about it saying how it violated their principles, but they thought the story was worth getting. So Macron knew exactly what he was talking about. So again, I just bring that back because the United States not only has problems with non-allies, they have problems with allies because their need to always do, first and foremost, what's good for the United States doesn't always sit well with some of those people who you call upon to enforce certain regulations. So I didn't want to let that go.
But I'd like to add one comment to the subject we discussed before. I mean, I've written recently about it because in Los Angeles and also in San Francisco, some buildings were sold, and in one case, a building was sold at a 45% discount to the price it was acquired in 2018. Another one was sold at also an over close to 50% discount to the price it was acquired in 2014. Their own tower, I think it was the third tallest building in Los Angeles. And the Fed must be scared stiff because commercial properties are owned by rich people and insurance companies and banks and so forth. But residential properties are still majority owned by people, by ordinary citizens. There must be scared stiff that residential properties would drop significantly if they keep on increasing interest rates. I mean, if people have bought properties, and it's less actually acute in America, because in America you can take out a 30 years mortgage, but not in Canada. In most countries, the length of the mortgage is much more limited. In Thailand, it's, I think, about 3 or 5 years. So in America, some smart people, they borrowed for 30 years, but others that have variable rates, they're going to be squeezed very badly. And the ones that own the 30 years mortgages, they have a problem in selling the building, because if they move somewhere else, the mortgage rates will be much higher that they will have to pay. So the inflated property market could become a problem in future, in my view. I mean, we have so many problems. We should all jump out of the window. But equally, we have many people in the world that are becoming more affluent and that can have a nicer standard of living. So there's also some good sides.
Yeah. Very interesting point.
And I was very encouraged that finally the peasants in Germany are rebelling and demonstrating very heavily against a completely incompetent leftist communist government of no knowledge at all. The Habeck, Scholz, Faber, all these people. I mean, Germany was an economic powerhouse. It's a shadow of its former self.
Mm-hmm.
Yep.
And just from developed markets to emerging markets, Dr. Oh, you have a question, Ira?
I do. So
yeah.
we talked about that almost last time. So if that's the case with Germany, and I believe you 100, I agree with you 100%. And the Germans guarantee their credit card, I should say, guarantees the ECB. The ECB is going to be another massive problem. Right now, it's not, because nobody wants to own up to that. But with the recent court rulings at Karlsruhe, there's some really interesting things. And Europe is moving to the right in response to that anyway. I mean, we have Italy. France is no layup as to what happens there and whether what's her name becomes president, which is, I mean, they got to get through the first run, but we'll see what goes on from there. But if really Germany balks at the whole thing, because it's just becoming, because having to carry the burden of the entire European Union financial system on its back and on its good name, could really bring problems forward.
Yes, that is why it's Richard asked me at the beginning, how I saw the dollar moving against the European currencies and so on. That I don't know, because it depends a lot on political developments. My sense is that say the dollar will keep on losing its purchasing power. Let's say that is the simplest statement that I can make, and that in the long run, gold and other precious metals will keep their purchasing power. In other words, compared to the dollar, they will go up, but it's more the dollar that goes down against these assets. But that aside, I think that we have in the emerging world, of course, currencies that would seem to be very undervalued. I mean, each time an American or a European he comes to Thailand, he's surprised at how low the price level is. But it depends about what, say food. You can buy food on the street for next to nothing. But if you want to buy a Porsche, you will pay 3 times the price of a Porsche in America.
Just a final question, Dr. Faber, on emerging markets. Which emerging markets do you currently like the most? Are you still bullish on Brazil, Argentina, we mentioned earlier?
Yes, but I believe that they have entered the correction time. And for the next few months, I don't expect Brazilian stocks to soar. I'm sort of keen on Colombia. It has great agriculture and a very depressed stock market and some reasonably good companies. So that is a market in Latin America I like. And I think in Asia, if I look around, I feel that Indonesian stocks are reasonably priced, whereby emerging markets, in my view, are not as cheap as they were in 2003, at the bottom of the cycle after the dot-com bubble burst, and not as cheap as in 2009. But statistically, relative to the US, the emerging market universe is at the lowest point in since the 70s or so. I mean, incredibly depressed. And Hong Kong property stocks now, many of them are at the same level than in 1996, 1997. So they're very depressed. And I must mention one peculiarity of Hong Kong property stocks. The property companies are majority owned or controlled shareholders are families. These families are enormously rich. These families never borrowed extensively. So you have Hong Kong property companies that have no debt, zero. Give me one property developer in the world, in the Western world, that has zero debts. Not one. So some companies, even if things go very bad, they'll survive. Of course, if the vacancy rate in in commercial properties goes up to 50%, they'll suffer. But I want to explain one point that is a difference between, say, Western commercial properties and commercial properties in Asia. In Asia, in the great cities of Tokyo, Seoul, Taipei, Hong Kong, Singapore, Jakarta, and so forth, people tend to live on small space, okay? So most people actually love to go to an office. It's like going on a holiday to go to an office in a nice building compared to the place where they live. And they live sometimes with the grandparents, because the social security in Asia is the family. So you have to look after your family. And therefore, the tendency to work from home is far less pronounced than, say, in the US, where people have big homes. They can easily allocate one room of their mansions to an office, a home office or so. But in Hong Kong, if you have to sit on a small space with the same wife the whole day, you go crazy. The women will say, if I have to sit with my husband the whole day, I also go crazy. I want him out of the house.
That's why I sit up in this office that my wife built for me. She couldn't listen to me. She had had enough, and I didn't argue with her. So she built me an office upstairs out of nothing, just so she wouldn't have to hear me.
From up there. Right, okay.
Okay, great.
Okay, thank you so much, Dr. Faber. Just any final thoughts, Ira, before we
No,
close?
No, I just love this. And you know what? People, there's no political discussion. All there is how to plug in politics maybe out of the policies to get to the best investable ideas. So we didn't throw that many out, but I don't think we're really changing from where we were last year. I still see certain Asian banks, so I just will leave that there. And I say this to people, especially because Mitsubishi owns 23%, as we talked about last year, of Morgan Stanley. They need to get a little more aggressive in going after, because everybody's just leaving a free road to UBS and a couple others in Asia for wealth management. Tokyo Mitsubishi, with its Morgan Stanley footprint, really should be out there developing a bigger wealth management footprint. I think it's there for the taking. The Japanese
I agree.
They haven't been very good at it. And I still love Commerce Bank. I'm not touting stocks. You should do the work. But when Jens Wiedmann became the chair, the executive chair, I think Jens Wiedmann is a wonderful, wonderful banker in the classic Otto Pohl sense of sound money banking. And I would think that Commerce, and they've now reinstated their dividend. So to me, that's an interesting stock. And I will plug one more thing into there. You have Europe, which doesn't have a broker-dealer system for the bond market, but they need one. And the ECB had actually done a study 4 or 5 years ago, I believe, where they said that if they went to that, you would have to be domiciled in the EU because they didn't want London or Wall Street dominating that. And so now what do we see? Ken Griffin with Citadel talking about getting into the European bond market. So I look at Commerce, if you're looking to buy your way in, there is and Commerce has been such an underperformer for 25 years. How long have they been trying to meld them into Deutsche Bank? That's never taken place, but I think they're probably in a better position now with some of the best bank leadership in Europe. So to me, it's something to watch. I'm not telling you to go out to buy it. Go do your work. It just made new highs though.
Yes, the stock is acting very well.
Yeah.
The technical picture is good.
Yeah. So I just wanted to put that out there just for conversation. So thank you. Thanks for taking the time, Dr. Faber.
Yes.
Thank you. Thank you, Ira.
Faber, Ira, thank you so much.
Thank you. Bye-bye.
Bye-bye.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.